Beneath the calm surface of America's neighborhoods, a quiet but urgent alarm is sounding across the housing market. The signs are subtle: empty streets, unsold homes, and a growing sense of unease among both buyers and builders. But make no mistake, the warning is real, and it's coming from the very top of the industry. The source? Lennar, the nation's second-largest homebuilder, a company whose fortunes often mirror the health of the entire housing sector. When Lennar speaks, or acts, the rest of the industry pays close attention. Recently, Lennar has issued what can only be described as a code red warning. This isn't a dramatic press release or a headline-grabbing announcement. Instead, the alarm is hidden in their latest financial results and a series of sudden strategic shifts in how they do business. On the surface, Lennar's revenue numbers look impressive, record highs that suggest a booming market. But dig deeper and the picture changes dramatically. Profits are collapsing and the numbers reveal a market far less stable than it appears to the casual observer. To keep sales moving, Lennar has resorted to aggressive tactics, slashing prices, offering massive discounts and piling on incentives for buyers. These moves may keep the sales figures up, but they come at a steep cost, gutting the company's profits and exposing the hidden weakness behind what looks like strong demand. If a giant like Lennar, with its deep pockets and national reach, can't make the numbers work, what does that mean for the thousands of smaller builders across the country? Many of them are already struggling, facing even tighter margins and fewer resources to weather the storm. For these smaller players, Lennar's struggles are a dire warning. If the big guys are hurting, the little guys may not survive at all. The ripple effects could be felt in communities nationwide as projects stall and jobs disappear. Lennar's recent decision to slow down sales isn't a show of strength or a calculated pause. It's a retreat, forced by harsh economic realities that are squeezing both builders and buyers from every direction. The code red is clear. Sky-high home prices, combined with soaring interest rates, have finally pushed many buyers to their absolute limit. Even those who want to buy are finding it nearly impossible to afford the monthly payments. As more buyers step back, the entire industry is forced to confront a painful reckoning. Builders, realtors, and homeowners alike are facing tough choices, and the path forward is anything but certain. The warning from Lennar isn't just about one company's profits, it's a signal that the American housing market is at a critical crossroads, and the next chapter could be even more turbulent. At first glance, Lennar's 2025 financial results seem to tell a story of remarkable success. The company reported billions of dollars in revenue, with sales figures that would make any competitor envious. On paper, it looked like Lennar was thriving, riding high on a wave of demand and outpacing much of the industry. Investors and analysts initially celebrated these headline numbers, believing the company had found a way to defy the broader slowdown in the housing market. But beneath the surface, the real story was far more complicated. Revenue alone doesn't tell the whole tale. Lennar's impressive sales were fueled by a growing reliance on massive incentives, price cuts, free upgrades, and even mortgage rate buy-downs, just to keep homes moving off the market. These aggressive tactics were necessary to attract increasingly cautious buyers, but they came at a steep cost. The company found itself in a position where selling homes, even at a loss, was preferable to letting inventory sit idle. This strategy can temporarily boost revenue, creating the illusion of robust demand, but it's ultimately unsustainable. Every discounted sale chipped away at Lennar's bottom line, eroding the profits that once set the company apart. Lennar's gross margins, which had long been a point of pride and a sign of operational strength, were now under intense pressure. The relentless need to offer deals and discounts squeezed margins to the breaking point, leaving little room for error or unexpected costs. What was once a healthy buffer had all but disappeared. It's a bit like a bakery that sells more cakes than ever before, but only because every cake is marked down to a loss. The shop is busy, the shelves are emptying, but at the end of the day, the register tells a different story. High sales volume can mask a collapse in actual profit, and that's exactly what was happening at Lennar. This disconnect between revenue and profit is at the heart of Lennar's code red. The surge in sales wasn't a sign of health, but a symptom of desperation. The company was doing whatever it took to move inventory, even if it meant sacrificing the very profits that keep a business afloat. Open houses were crowded, but many visitors were just browsing, not buying. The illusion of success couldn't last forever. As the months went by, Lennar was forced to confront the harsh reality of collapsing profitability. Executives faced tough questions in tense boardroom meetings, and the pressure mounted as profit charts continued to trend downward. Now, the market is waking up to the truth behind the numbers. Investors and analysts are looking past the record revenue and focusing on what really matters: sustainable profit. The story of Lennar in 2025 is a cautionary tale, a reminder that big sales numbers can hide even bigger problems lurking just below the surface. Homebuilder incentives are meant to sweeten deals, but in 2025, Lennar's incentives became massive price cuts in disguise. By the third quarter, incentives averaged over 14% of a home's value, sometimes more than $60,000 off per home. This obliterated profit margins, turning a temporary tactic into a dangerous standard. Builders rely on healthy margins, but giving away so much erases nearly all profit. The root cause: buyers simply can't afford today's prices and rates without help. Incentives are just hidden price cuts, and eventually, the math stops working. Lennar's pullback is an admission that this strategy is no longer viable. Wall Street cheered Lennar's high revenue and sales, missing the real danger: collapsing profits. Analysts focused on growth, ignoring the cost of achieving it: massive incentives that permanently slashed earnings. This revenue obsession created a false sense of security, masking the erosion of Lennar's ability to fund future growth. In home building, profit is survival. Without it, even giants stumble. The real warning was in the margins, not the sales numbers. When Lennar's leadership admitted they had to slow down, the illusion shattered. The market was forced to confront the truth. The high-revenue, low-profit model had hit a wall. The industry's health is far more fragile than the headlines suggest. Lennar's recent struggles aren't just an isolated event. They're a clear reflection of a much broader crisis that's rippling through the entire home building industry. The challenges Lennar faces are being echoed by nearly every major player in the market, signaling a shift that's impossible to ignore. Other giants like D.R. Horton and KB Home, both household names in American home construction, have also reported significant drops in revenue. To keep buyers interested, they're increasingly relying on a growing arsenal of incentives. Everything from mortgage rate buydowns to free upgrades and closing cost assistance. In fact, nearly 40% of builders across the country are now slashing prices outright, hoping to spark demand in a market that's cooled dramatically over the past year. And it doesn't stop there. About 2/3 of builders are layering on additional incentives, sweetening the deal for buyers who are hesitant to make a move in today's uncertain economic climate. This isn't just a temporary dip or a seasonal slowdown. The empty open houses and rows of unsold new homes are a stark reminder that weak demand is now the new normal for the industry. Builders typically only resort to discounts and incentives when they're struggling to move inventory. When homes aren't selling, the pressure mounts quickly, forcing companies to make tough decisions just to keep cash flowing. Unsold inventory isn't just a number on a spreadsheet. It represents millions of dollars tied up in land, materials, and labor. For builders, every unsold home becomes a costly burden that eats into profits and threatens future projects. Lennar's code red moment is just the most visible warning sign. When a company of Lennar's size hits the brakes, it sends shockwaves through the entire sector, making it clear that no builder is immune to these market forces. The reality is, the entire industry is under intense pressure. From the largest national firms to smaller regional builders, everyone is feeling the squeeze as sales slow and competition heats up. As Lennar pulls back on new projects and tightens its operations, its peers are left facing a difficult crossroads. Should they accept lower sales volumes or keep sacrificing profits by offering ever bigger incentives just to keep buyers interested? This so-called incentive war can't go on forever. It's a race to the bottom that's simply unsustainable, and eventually, something has to give. The weakness in the market is now impossible to ignore. For home builders, the path forward is uncertain, and the choices they make in the coming months could reshape the industry for years to come. The root of the crisis is simple. Homes are unaffordable for millions, prices remain near historic highs, and mortgage rates are still elevated, making monthly payments unmanageable. Rising unemployment and high living costs have created a confidence recession among buyers. New home sales are falling, and buyers are waiting for real relief, either lower prices or rates. The pool of motivated buyers is shrinking, especially among first-timers. Lennar's incentives were a costly attempt to bridge the affordability gap, but even they can't absorb the cost forever. Their retreat signals that the market's affordability problem has reached a breaking point. While Lennar sounds the alarm, small builders are in even deeper trouble. Lacking scale and access to cheap capital, they're squeezed by high land costs, tighter lending, and labor shortages. Many bought land at peak prices and now can't sell homes at a profit. Big builders can offer incentives and weather losses. Small builders can't. As conditions worsen, small firms are being pushed out, sometimes into bankruptcy. For them, a few unsold homes can mean disaster. Lennar's warning is a flood siren for Main Street builders already underwater. The housing crisis is being amplified by a weakening economy. Unemployment is rising, job growth is slowing, and consumers are cutting back on spending. High interest rates and persistent inflation make borrowing expensive and erode household savings. Even major corporations and other sectors are struggling, signaling a broad economic slowdown. A weak economy reduces housing demand, and a slowing housing market hurts the economy in return. As builders pull back, the ripple effects will be felt across jobs and related industries. The perfect storm of weak demand, high rates, and economic uncertainty makes a housing correction increasingly likely. Lennar's Code Red is the first major domino to fall, marking a turning point for U.S. housing. Watch how other big builders respond. Will they slow sales and construction too? Pay attention to small builders. Layoffs, halted projects, or bankruptcies signal deepening trouble. Monitor housing inventory and list prices. More stale listings and public price cuts mean buyers have the upper hand. The broader economy and Federal Reserve actions will drive what happens next. Rate cuts could help, but a deeper recession would hurt demand even more. The path forward is uncertain, but the warning is clear. The ground beneath the housing market is shaking. Stay alert. The next moves will shape the future of American real estate.